Silver isn't at one price anymore. Right now it's splintered into multiple realities, and the only people pretending this is normal are the people who benefit from you staring at the wrong number. The screen can say 70-something, the headline can say 80, and a real invoice for immediate metal can whisper something far uglier. 90, 108, 125. And yes, even numbers that sound impossible if you're still living inside the comfort blanket of spot. And here's the conflict nobody wants to say out loud. The paper benchmark wants you calm, because calm keeps liquidity flowing and keeps spreads contained, but the physical market is forcing a different conversation with every ounce that refuses to show up where it's supposed to. The hidden mechanism is not drama, and it's not a fairy tale shortage. It's plumbing, it's location, it's deliverability, it's financing, and it's timing. And by the end of this, you're going to have a clean near-term roadmap. What matters next week? What level flips the whole setup? What confirms the squeeze pressure is still building? And what would actually invalidate this so you don't get emotionally baited into the worst decision at the worst moment? Because if you only do one thing right in a fractured market, it's this. You stop arguing about the price, and you start tracking where the price is being forced to tell the truth. And that's where the real pressure starts. When you see 5 prices, you're not seeing confusion. You're seeing 5 different doors, and each door has its own line, its own bouncer, and its own fee. One door is the clean institutional lane. Big bars, deliverable specs, settlement rules, the kind of metal that can actually satisfy a contract when the music stops. Another door is the London-style settlement ecosystem, deep, liquid, and normally the quiet heart of global price discovery, until inventory gets pulled out, policy uncertainty jams flows, and suddenly deep and liquid turns into deep, but not where you need it. Another door is Asia's physical pricing, where if the local bid is hot enough, it can set a magnet that pulls real metal across oceans, if logistics, licensing, and financing let it happen on time. Then you've got the wholesale fabrication and distribution lane, where the metal exists, but it can't instantly turn into the products people actually buy, and that conversion time becomes its own premium. And then you've got the retail lane, where emotions, small unit scarcity, dealer risk management, and replacement cost collide into numbers that make the benchmark look like a polite suggestion. The screen is one number. Your ability to actually source silver is another number. Your urgency is another number. Your form factor is another number, and your jurisdiction is another number, but that's not the part that matters. The part that matters is what it forces participants to do. In a single price world, arbitrage keeps everyone honest. In a 5-price world, arbitrage is either blocked, delayed, or too risky to scale, and that's when the one-price myth breaks in public. You saw it in the tape this week. Silver has been swinging violently, snapping upward, dumping hard, and then rebounding like it's attached to a rubber band made of panic. We're not talking about gentle trend movement. We are talking about intraday moves that feel like someone keeps yanking the floor and then rebuilding it under your feet. That behavior is a symptom. It's what happens when inventory sits in the wrong places, when liquidity thins, and when both hedgers and speculators are forced to trade around deadlines instead of preferences. Think of it this way. A calm market is like a highway at midnight. Fast, smooth, predictable. A stressed market is like a city with half the bridges closed and the rest under construction. Cars still move, but not where you expect. Not at the price you planned, and not on the schedule you need. The benchmark number on the screen is the advertised travel time. The real cost is what you pay when you hit the closures. Because if you need metal now, the market doesn't care about your screen. The market cares about settlement, and settlement is where fantasy dies. Here's the hidden detail that reframes the whole story. The world can have plenty of silver and still have a shortage of deliverable silver in the specific hubs that matter for benchmark setting and contract performance. That sounds subtle, but it changes everything. In commodities, supply isn't just tonnage. It's deliverable tonnage in the right form, in the right location, under the right title, at the right time. And the moment those constraints tighten, you don't get one price. You get a stack of prices. Because some ounces are good enough for jewelry fabrication, but not positioned for immediate wholesale delivery. Some ounces are in vaults, but not registered for delivery. Some ounces are technically eligible, but owned by someone who has no reason to convert them into deliverable status, unless you pay them to give up control. Some ounces are in the wrong country, behind export friction, or stuck in a financing chain where moving them creates a balance sheet headache. And some ounces are already spoken for by industrial procurement that doesn't care about your chart, only your ability to supply at a fixed date. That's the part that flips the whole setup. When a benchmark market starts to feel like it's being set by scarcity of convenience, not scarcity of existence, spreads become the truth serum. Now let's talk mechanics, because this is where trust is earned. A lot of people talk about paper versus physical like it's a philosophical argument. It's not. It's a settlement argument. Futures and OTC paper markets exist to transfer price risk, not necessarily to move metal. Most contracts never go to delivery. That's normal, that's healthy, but it creates a dynamic where the headline price can be set by the marginal trade in paper, while the physical market can quietly tighten underneath. When the physical market tightens enough, it doesn't always immediately lift the benchmark price in a clean and linear way. It often shows up first as a distortion. The basis, the spread, the premium for immediacy, the cost to replace inventory, the reluctance of holders to part with deliverable bars, the widening gap between regional markets, and the little friction fees that suddenly get bigger. And once those distortions go visible, they stop being nerd trivia. They become the market. Because if you can't convert paper exposure into physical access at anything close to the benchmark, then the benchmark is no longer a complete price. It's a partial price. And markets hate partial prices. Markets resolve them, one way or another, usually violently. And that's where the real pressure starts. One of the cleanest ways to understand this without getting lost is to focus on immediacy. In normal times, the market rewards patience. You can buy forward, you can hedge, you can rely on steady flows, and you can assume a small carry cost. In stressed times, the market punishes delay. It starts paying a premium for now, and that shows up as backwardation, near-term prices, above longer-dated prices, or as a blowout in physical premiums relative to the futures benchmark. Backwardation is the market's confession. It would rather pay more today than trust tomorrow. And if you're thinking, but why would anyone pay up when they can just buy a futures contract? That question is exactly why this matters. Because a futures contract is not an ounce in your hand. It is a promise, with rules, with delivery windows, with eligible versus registered categories, with settlement mechanics, with potential for cash settlement or roll pressure, and with counterparties who manage risk by doing whatever keeps their book alive. In other words, the futures price is the price of exposure. The physical premium is the price of certainty. And in a market where certainty is scarce, certainty becomes expensive. But that's not the part that matters. The part that matters is what it forces the system to do. If spreads blow out, the people who are short exposure have a choice. Deliver metal, source metal, roll their exposure forward, or close their short. Delivering metal requires deliverable bars in the right place, on the right schedule. Sourcing metal requires paying up, and when the market senses a forced buyer, it widens the door fee. Rolling exposure can become more expensive if the curve is backwardated, or if liquidity in the right contract months is thin. Closing the short means buying back contracts, which is how you get reflexive moves. Price rising, because risk management forces buying into rising price. This is not a moral story, it's a mechanical story. And mechanical stories don't care about anyone's opinion. They care about constraints. Now bring in the global layer, because silver is not just a Western futures game. When regional premiums spike, especially in big physical demand centers, you get a gravitational pull. If Shanghai is paying materially more than London or New York, in theory that invites arbitrage. Buy where it's cheap, ship where it's expensive, pocket the spread. In practice, that arbitrage has friction. You need the right bar sizes and refiners. You need logistics capacity. You need insurance. You need time. You need the legal and licensing environment to cooperate. You need financing to carry inventory while it moves. And in the real world, those constraints can be the difference between one global price and 5 simultaneous prices. Because the arbitrage that would normally close the gap can't scale fast enough, or can't happen at all, during the window when demand is hot and liquidity is thin. And that's where the market fractures. The most important thing to understand about a fractured market is that it creates local price discovery. Each region clears its own imbalance. Each supply chain pays its own urgency tax. Each participant recalculates their risk. And the more fractured it gets, the more the benchmark becomes a lagging indicator. Not because it's fake, but because it's incomplete. It's a price for a specific lane. Meanwhile, physical demand is pricing a different lane. And the lane with urgency tends to win in the short term because it forces action, but that's not the part that matters. The next detail is what flips the whole setup, calendar pressure. People underestimate how much right now in markets is actually right now because the calendar says so. Early January is not just a fresh page. It's thin liquidity in pockets, it's funds resetting positioning, it's desks getting back to full staffing with new risk limits, it's dealers updating replacement costs after a violent year, and it's the market transitioning from holiday conditions into a more aggressive rhythm. Add in the delivery cycle mechanics and option expiry dynamics, and you get a recipe for sharp moves. If options are stacked around certain strikes, hedging flows can become the invisible hand that pushes price toward pain points. If the market pushes through a key level, gamma and delta hedging can turn into forced buying or forced selling, not because anyone believes anything, but because the math demands it. This is where you see those sudden vertical candles and the equally sudden air pockets. And if you're only watching headlines, it looks irrational. If you're watching positioning and deadlines, it looks inevitable. Now zoom into the supply chain reality, because this is where people get trapped by simplistic narratives. Silver supply is not a faucet. A large chunk of global silver output is produced as a byproduct of other metals. That matters because it means you can instantly ramp silver production just because the silver price went vertical. If zinc, lead, copper operations are the main engine, silver is riding in the passenger seat. Refining and processing also have lead times. Recycling responds, but it responds with delay and only up to a point. Fabrication capacity, turning raw bars into the specific products the market wants, also has bottlenecks. So when demand pulses, the first thing that tightens is not global ounces forever. It's available ounces in the right form, in the right place, at the right time. That's why you can see retail premiums explode even when wholesale bars still exist. Because the product people actually buy is a different pipeline than the pipeline that settles big institutional trades. Retail doesn't just pay for metal. Retail pays for fabrication, distribution, dealer balance sheet risk, and replacement uncertainty. And when replacement uncertainty spikes, dealers price defensively. They widen premiums to protect themselves from selling inventory they can't replace without taking a loss. That's not greed, that's survival. And it creates another price. Now stack the proof, because one argument is never enough in a market like this. Proof point one is volatility itself. Now, when a market starts swinging like a door in a storm, it's often because liquidity is thin and risk managers are in control, not long-term investors. Proof point two is the location story. When physical inventories concentrate in one hub while another hub drains, the benchmark hub can become stressed, even if total inventory exists. Proof point three is the regional premium story. When Asia IS physical bid runs hot relative to Western benchmarks, it signals real demand and/or local supply constraints, and it creates a pull that can keep metal from flowing back to the benchmark hub quickly. Proof point four is the institutional flow reality. Investor demand can be strong without being maxed out, and ETF holdings can be below prior peaks even while price is violent, which tells you this isn't T, just a crowded one-way trade. There S, still room for flows to matter. Proof point five is the term structure signal. If near-term pricing is repeatedly being bid up relative to forward pricing, that's urgency, not just optimism. Proof point six is the retail symptom. If small products are priced at eye-watering premiums or show delays, that's the end of the pipeline flashing red, even if the middle of the pipeline still looks okay. And none of these alone proves to the moon. But together they prove something more useful. The market is under stress, and stress resolves through either flow, normalization, or repricing. Because if this one level breaks, the math changes. Let's talk about those 5 numbers in the title in a way that keeps us honest. Not every viewer will see the exact same quotes, because that's the point. Fragmentation means the price you can access depends on your lane. You can have a benchmark or futures print in the mid to high 70s right now, and you can also have wholesale physical lanes clearing higher depending on location and urgency. In one lane, you might hear prices in the low 80s for larger bars or prompt settlement equivalents when everything is functioning but tight. In another lane, you can see higher effective prices once you include the premium demanded for immediate delivery or for sourcing metal out of a constrained region. In another lane, you can see 3-digit effective pricing for certain retail products when the dealer is not selling quantic spot metal, they're selling certainty plus fabrication plus the right unit size plus immediate availability. And in the most stressed lane, small size, limited stock, high demand, and replacement risk, you can see sticker shock numbers that look like a different planet. That does not mean the global benchmark instantly becomes 147. It means the market is showing you what the marginal buyer pays when the product they need is scarce in their lane. And that matters because marginal price is contagious. It spreads. It changes behavior. It changes hoarding. It changes hedging. It changes industrial procurement. And it changes sentiment in a way that can feed back into the benchmark. But that's not the part that matters. The part that matters is what happens next. Because fractured markets don't stay comfortably fractured. They either heal or they break further. Healing looks like metal moving back into the benchmark hub, spreads compressing, backwardation easing, and premiums calming as replacement becomes reliable again. Breaking further looks like continued regional premiums, continued urgency pricing, tighter deliverable availability, and a benchmark that is forced to chase the physical reality upward in bursts. And those bursts are where most people get emotionally destroyed because they buy late into excitement, they puke on the first dump, and they miss the actual resolution move. That's why we need a psychology shield right now. Here it is. Assume the market will try to embarrass you out of a correct thesis with violence. Even if the thesis is correct, price can whip around brutally. That's not a bug. That's how leveraged markets transfer money from impatient hands to patient ones. The headline will alternate between silver is breaking out and silver is collapsing, within days, sometimes within hours. The same commentators who were terrified at 70 will tell you it's overextended at 80, and then tell you it's dead at 75, and then tell you it's unstoppable at 82 again. That emotional carousel is designed by the structure, not by a villain. It's what happens when options, hedging, margin calls, and thin liquidity amplify moves. So the discipline is simple. Separate trend signal from noise. Noise is the intraday flush that happens because someone hit a margin threshold. Noise is the wick that prints in thin conditions. Noise is the headline that arrives after the move. Trend signal is the persistence of spreads, the behavior of term structure, the ability of price to hold key zones after pullbacks, and the repeated failure of dips to fully unwind the underlying stress indicators. If you anchor on that, the market has a harder time manipulating your emotions. Because the market doesn't need to lie to you. It just needs to make you feel dumb long enough to make you quit. And that's where the real pressure starts. Now, let's get practical with the near-term map. Silver has recently been trading in the mid to high 70s with violent swings after ripping higher into the low 80s and even tagging record territory in late 2025 around the mid 80s. That tells you the battlefield. Well, one key zone is the low 70s area because that S, where the market found its footing as the year turned and where a lot of cheap again demand shows up. If we see a controlled pullback into the low to mid 70s that stabilizes and spreads, remains stubbornly elevated, that's a classic retest setup. Price cools, pressure stays, then continuation becomes more likely. Another key zone is the high 70s to low 80s region because that RS, where the market keeps showing you whether it can accept higher prices or whether it has to dump to clear leverage. If price reclaims and holds above the upper 70s and starts pressing the low 80s again with spreads staying hot, you're in the continuation risk zone. And the big psychological battlefield is the prior highs in the low to mid 80s, because clearing that zone changes how risk managers see the world. Above old highs, short hedges get nervous, call options become more sensitive, and liquidity can thin because sellers step back. That's where squeezes happen. Not because the world ends, but because the market structure gets fragile. And if you're the person who needs physical now, you don't wait for the chart to bless you. You pay up. That's how physical tension can lead paper. But that's not the part that matters. The part that matters is the two-scenario lens because it keeps you sane. Scenario 1 is the controlled pullback and retest. Price pulls back into support zones. Think low to mid 70s. Volatility stays high but not catastrophic, and the market spends time chewing through supply. Spreads and physical premiums stay elevated, but maybe they stop widening. That would be constructive. It would tell you the stress is real, but being managed. In that scenario, you watch for stabilization, you watch for the market refusing to break down despite scary headlines, and you watch for the next push higher to come with less drama. Scenario 2 is the continuation squeeze and gap risk. Price holds the upper 70s, pushes into the low 80s, clears the recent highs, and then the market starts gapping because liquidity thins and hedging demand accelerates. In that scenario, you watch for signs of forced buying. Sharp vertical moves, shallow pullbacks, and physical premiums refusing to cool even as the benchmark rises. But you also respect the danger. Gap risk cuts both ways. The same structure that can rip upward can also air pocket downward if a big player de-risks. If margins rise, if a policy headline unlocks flows, or if metal suddenly returns to a stressed hub and spreads compress fast. Both scenarios can be true within the same month. That's why you don't get hypnotized by one candle. You track the mechanism. Now, what would confirm the thesis that the 5 prices phenomenon is a real signal and not just temporary noise? Persistent regional premiums, especially if they stay elevated even after benchmark pullbacks. Persistent signs of immediacy preference in the curve, near-term strength relative to forward. Continued talk from the street that inventory is stuck or in the wrong places, which is exactly the kind of phrase you hear when arbitrage is blocked. Evidence that metal is not freely flowing back into the benchmark hub in size. Continued retail tightness and elevated small product pricing. Not as the core proof, but as the emotional amplifier that tells you the pipeline is still constrained at the end. And watch institutional behavior. If ETF holdings and investor participation start rising meaningfully from already elevated conditions, that adds fuel. What would weaken it? Spread compression, a clear normalization of regional premiums, signs that inventories in key settlement hubs are replenishing in a way that reduces urgency. Policy clarity that removes the incentive to strand metal in one region, or a macro shock that destroys industrial demand expectations and forces a broad liquidation. Notice what's not on the list. A pundit says it's over. Markets don't end because someone gets bored. They end when constraints ease or when demand collapses. But that's not the part that matters. The part that matters is how to watch this without getting used. Here is the viewer psychology shield in plain language. The market will use volatility to make you confuse motion with information. Your job is to downgrade motion and upgrade mechanism. When silver dumps $3 in an hour, ask, did spreads cool? Did physical premiums collapse? Did the curve normalize? Did inventories visibly return to the stressed hub? Or did a leveraged cohort just get margin called? When silver spikes $4 in a day, ask, did it spike on thin liquidity with a giant wick? Or did it spike while spreads stayed hot and pullback stayed shallow? Did it spike into a known option strike cluster where hedging could amplify it? Or did it spike on a real supply chain headline that changes flow expectations? Those questions keep you rational. And being rational is the edge, because most people aren't losing money because they're wrong about silver. They're losing money because they're right at the wrong time with the wrong behavior. They buy after confirmation, when risk is highest, and sell after fear, when opportunity is highest. The structure feeds on that. Don't feed it. Now, let's address the skeptical voice that says, if physical is so tight, why isn't spot already at 125? Because markets don't reprice smoothly when the problem is friction. They reprice in steps. First, the premium rises in the constrained lane. Then the premium persists. Then participants change behavior, hoarding, withholding, delaying sales, paying up for certainty. Then spreads widen. Then hedgers adjust. Then arbitrage tries to respond but hits constraints. Then the benchmark is forced to incorporate the higher clearing price. But it does it in bursts because it's driven by flows and positioning. Meanwhile, pockets of the market continue to print different effective prices because form factor, jurisdiction, and immediacy remain different. The benchmark is the lowest friction lane. The other lanes are pricing friction. When friction grows, those lanes diverge. And the only way they converge is either friction collapses or the benchmark rises enough that it draws supply back into the benchmark lane. That's the real balancing act. And it's why the phrase, the price is lying, is so useful right now. Not because the price is fake, but because it's incomplete. The spread is the missing sentence. Now, one more layer people ignore. Balance sheets. In stressed conditions, metal movement isn't just a truck and a vault key. It's financing. It's credit lines. It's collateral treatment. It's risk-weighted assets. It's internal limits. A dealer might have access to metal, but not the balance sheet appetite to warehouse it when volatility is this wild. An institution might have eligible bars, but not want to convert them into deliverable status because it changes their liquidity profile. A refiner might have feedstock, but not the capacity schedule to output the specific bar sizes demanded right now. A trader might see the arbitrage, but not have the capital to sit through the time-to-ship risk while the market whipsaws. Those constraints don't show up on your chart. They show up in premiums. And when premiums start stacking, that's the market telling you the balance sheet is the bottleneck. But that's not the part that matters. The next part is the why now trigger you can actually watch. Early year positioning resets are one, thin liquidity pockets are another, delivery and expiry windows are another, and then you have policy uncertainty that can strand inventory where it sits. When uncertainty rises, people hoard convenience. They want metal close to home, close to their jurisdiction, close to their delivery points, close to their customers. The hoarding is rational from their perspective. It's also destabilizing for the global benchmark ecosystem. Because the benchmark ecosystem depends on metal being willing to sit in the benchmark hub and be available. When it isn't, the benchmark hub becomes stressed, and stressed hubs produce spread signals. This is why even big, transparent vault holdings don't automatically reassure you. You can have large tonnage on paper and still have tightness in deliverable availability if the metal is not positioned, not registered, or simply not for sale at anything near the benchmark. That's the hidden detail again. It's not, is there metal? It's, is there metal that will actually move under pressure? So what do you watch this week and next week if you want to stay ahead of the crowd without pretending you can predict every tick? Watch whether price respects the upper 70s as a new floor after pullbacks, or whether it collapses back into the low 70s and stays there. Watch whether any pullback is met with immediate premium resilience in physical lanes, meaning the physical market doesn't forgive the skimmerlines on the dip. Watch for signs of spread compression. If the spread compresses hard while price holds, that can be stabilization. If the spread compresses because physical demand evaporates, that's different. Watch for the kind of days where price dumps but then closes strong. Those are often the days leverage gets cleaned out and the market resets higher. Watch for the days where price rips but then leaves a giant wick and fades. Those are often the days liquidity ran out and the market punished late buyers. And watch the psychology in yourself. If you feel certain, you're probably late. If you feel embarrassed, you're probably early. That's not always true, but it's a useful mirror in a market that's designed to mess with you. Now let S get to the payoff you were promised, the clean checklist and the invalidation concept. Confirmation checklist, sustained strength above the upper 70s with repeated defenses of dips, renewed pressure toward the low 80s with spreads staying elevated, physical premiums, refusing to normalize even when price pulls back, and continued evidence of regional pricing divergence. Invalidation concept, a clean breakdown through the key support zone that holds for more than a headline cycle, paired with visible normalization of premiums and curve structure. In other words, not just price down, mechanism easing. Price can drop and still be bullish if the mechanism remains tight. Price can rise and still be fragile if the mechanism is easing. That distinction is the edge, and it's why you don't have to worship any number in the title. You use the numbers as signals of fragmentation. Fragmentation is the message. Now, a final warning that most people ignore. Volatility will be used against you even if you were right. If silver continues to be this wild, there will be days where it feels like the market is personally targeting you. It's not. It's doing what stressed markets do, transferring risk from the impatient to the patient, from the overlevered to the well-positioned, from the headline chasers to the mechanism watchers. If you're going to participate, you respect that truth. You keep your time horizon clear. You don't confuse a one-day dump with a regime change. You don't confuse a one-day pump with a guarantee. And you remember that there are two kinds of pain in markets: the pain of being wrong and the pain of being early. Most people can't tolerate the second one, so they guarantee they'll experience the first. Don't do that. If you're here for mechanics, not memes, you're in the right room. Because this silver market is going to punish anyone trading vibes. And the most powerful thing you can do right now is be the person who watches the spread, watches the curve, watches the flow, and stays emotionally unhooked while everyone else gets hypnotized by the screen. If you want to keep tracking this together, stay close to the community that cares about structure, not slogans, because the next week or two is going to be about whether fragmentation persists, whether the benchmark is forced to chase, and whether the market tries one more violent shakeout before the next leg reveals itself.